Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Monday, everybody. I hope you had a restful weekend, and I wish you all a productive week ahead. Today's video contains a sponsored feature. Sponsored features are limited to just a few a month to ensure that the channel is financially sustainable without being too intrusive for the viewer experience. The feature will be labeled throughout, and if you would like to know how I work with sponsors, this is in the description below. Let's begin. Over the weekend, at least 11 people died and dozens are missing in a partial collapse of a highway bridge in the northwest province of Shanxi following heavy storms and flooding. According to state media, 5 vehicles that fell off the bridge have been recovered after the structure crumbled at around 8:40 p.m. Friday evening. As of Sunday, some 20 cars and 30 people are still missing. General Secretary Xi Jinping urged all-out rescue efforts, saying that China is in a critical period for flood control and local governments must take responsibility to enhance monitoring and early warning. China's National Fire and Rescue Authority said on Saturday that it had dispatched a rescue team to the site that included 859 people, 90 vehicles, 20 boats, and 41 drones. The Shanxi incident is China's second deadly infrastructure collapse caused by rainfall and flooding in recent months. In early May, nearly 50 people died after a section of the mountainside highway collapsed in southern Guangdong province following days of heavy rain. As its economy boomed over recent decades, China built a large network of highways, airports, and other infrastructure. However, at times poor quality building, poor safety supervision, and a desire to cut corners in some regions by industries looking to save money have led to a steady stream of deadly accidents. The incident comes as wide swaths of northern and southwest China grapple with torrential rain and flooding and a continued onslaught of extreme weather nationwide. As of 2 a.m. on Saturday, more than 30 people had been reported missing and more than 40 houses damaged due to flash floods caused by heavy rains in a county in the mountainous southwestern province of Sichuan. State media said on Saturday that roads, bridges, and communication networks in the county had been damaged or knocked out, and that rescue teams had been working since before dawn to restore communications and transport connections. China's western and southwestern provinces are particularly prone to flooding and landslides due to the mountainous landscapes and the powerful rivers that run through them. Extreme weather continues to hit other provinces in China too, with heavy rainfall and heat waves over the weekend. Temperatures topped 40 degrees Celsius on Saturday in parts of Fujian province. Let me just check, actually, how much is that in Fahrenheit? 104 degrees Fahrenheit. With the heat wave forecast to run through the 25th of July. The northeastern city of Shenyang in Liaoning province issued a heavy rainfall red alert, the highest level in a 4-tier system, according to state media. Next up, over the weekend, US-based Rhodium Group published an excellent report called No Quick Fixes, China's Long-Term Consumption Growth. The report explains what is holding back household consumption in China and examines the policy debate over how to catalyze consumer spending. It's a brilliantly comprehensive yet concise exploration of these themes, and it's worth taking a few moments here to note the points made in the executive summary, which we will quote, briefly edited for brevity, directly here. Investment-led growth has peaked in China, as the financial system can no longer generate the same pace of credit expansion as in the past decade. With this source of growth drying up, household consumption growth will be the single most important determinant of China's long-term economic trajectory and growth rate. In this report, key findings include 1. In the absence of significant fiscal reforms, long-term household consumption growth is likely to slow to around 3 to 4% per year in real terms over the next 5 to 10 years. At most, household consumption will contribute to around 1.5 percentage points of GDP growth per year, which is likely to limit overall long-term GDP growth to around 3%, given the known headwinds to faster investment growth. 2. China's household consumption growth has slowed more sharply in recent years than official economic data claims.
Household savings have risen significantly, and consumer confidence has collapsed. Alternative data series point to declining household spending in 2022 and only a modest recovery in 2023 and early 2024. 3. Household consumption is constrained in China by low levels of household income and a highly unequal distribution of income. Fiscal transfers from the state to lower-income households would catalyze additional spending, as would a more progressive distribution of income. Reducing savings rates alone is unlikely to boost overall spending significantly, given the low levels of savings among lower-income households. 4. Over the past decade, China's household debt levels have risen sharply, along with the property bubble and the rise in mortgage finance. As a result, many households are struggling to pay down debts, with little left over to spend on consumption. Household debt has risen by around 32% of GDP from 2012 to 2022, and has since stabilized at around 64% of GDP. Household debt in China is quite large relative to household income, at an estimated 145%, according to the Household Survey data. 5. There is no quick policy fixes to China's slow pace of household consumption growth. The imbalances in China's economy have widened for several years, and only a complete restructuring of the economy, the fiscal system, and a government-led redistribution of income will change that pattern. Here ends the direct quote of the report's executive summary. Now we're going to explore this a bit more and unpack some of these ideas, but first we will move into the sponsored content. The world is going through historic shifts, affecting everything from geopolitics to global energy and commodity markets. There are signs of global order fragmentation. Washington and other industrialized capitals around the world recognize the importance of bringing critical supply chains and mining operations back home. This is the case with lithium, this is the case with uranium, and it is particularly the case with nickel. Currently, the US only has one active nickel mine, and it appears to be running out of ore. Before the EV revolution, nickel was primarily used to make stainless steel. Today, stainless steel is still the most important use, but consumption of nickel for EV batteries is rising rapidly. Nickel is one of the most critical components of batteries that power EVs. Big players are seeing the trend already. Recently, Samsung, Anglo American, and Agnico Eagle have all made large investments into nickel mining in Canada. We could be on the eve of a big investment rush into this area. That's where today's video sponsor, Alaska Energy Metals, provides an excellent trade opportunity for savvy investors looking to take advantage of these historic shifts. 6 factors make this company stand out. Financing. The company has raised capital to fund its drilling programs and additional capital expenditures at 50 cents Canadian, then 40 cents Canadian, then 28 cents Canadian, and recently 15 cents Canadian. The stock now trades at 14 cents Canadian. No one has ever bought shares in this company cheaper than at this point. 2. Management improvements. Just recently, Mario Vetro joined the board of directors and will be instrumental going forward. Mario co-founded K92 Mining, which employs 1,600 people in Papua New Guinea, where the company produces high-grade, low-cost gold and trades for a nearly $2 billion market cap. 3. Peer comparison. Alaska Energy Metals owns a nickel resource containing 8 billion pounds of nickel, and its market cap is 14 million Canadian. Canada Nickel owns a resource of 13 billion pounds of nickel and has a market cap of 250 million Canadian dollars. 4. Valuation. The previous 2 owners of the Nikolai Nickel project spent a collective $36 million since the 1990s, before Alaska Energy Metals took control of it. In other words, the company's market cap today is 66% below what the previous owners had already spent on it. 5. Nickel bull market. There is almost no nickel mining in the United States. It imports almost all of its new nickel the country needs, and policymakers want to bring nickel supply chains back to North America. 6. Cobalt Metals, a privately held AI-driven mining company whose shareholders include Michael Bloomberg, Jeff Bezos, Bill Gates, Jack Ma, Ray Dalio, and Richard Branson, secured mineral rights to a land tract right next to where Alaska Energy Metals is exploring and developing their nickel deposit. Mining, exploration, and development companies are speculative opportunities, high risk, but also potential for very high reward too. Owing to a variety of unfortunate timing circumstances, Alaska Energy Metals is currently valued very low. Being a contrarian in the cyclical metals business can mean great upside potential. Alaska Energy Metals is a serious explorer developer that has documented a large nickel deposit on American soil in Alaska and is worth looking into. We remember that all investment involves risk. This sponsored feature is not individual investment advice. Always speak to an investment professional and do your own due diligence before making any investment decision. A big thank you to Alaska Energy Metals for sponsoring this episode of China Update. Okay, let's move back into regular coverage. Peking University Professor of Finance Michael Pettis, someone who we often quote on China Update, regular viewers know this very well, published a long response to the Rhodium report on consumption. He largely agrees with the points made, but added 3 more points. First, if China can manage 3 to 4% consumption growth rates as they rebalance the economy, that would be pretty good, he argues, by historical standards. It would only be a little below the pre-COVID consumption growth rate. Second, as China rebalances, GDP growth will largely be a function of consumption growth by definition. It turns out that this is pretty easy to calculate the relationships, he says, depending on what rebalancing assumptions you make. Quote, let's assume a very gentle and optimal rebalancing. Assume China has 10 years to bring the investment share of GDP down by 10 percentage points. That is pretty generous. China's huge debt burden might give it a lot less than 10 years. It's also worth noting that a 10 percentage point reduction in the investment share of China's GDP still leaves it with one of the highest investment shares in the world. After over 3 decades of massive investment, it will probably need to bring it down a lot more than that. Nevertheless, this relatively gentle rebalancing allows us to set our growth parameters. It turns out that the math is pretty easy. In order for China to reduce the investment share of its GDP by 10 percentage points over 10 years, an annual average consumption growth rate of 3 to 4%, assuming no massive shifts in its trade surplus, would be consistent with an average annual GDP growth rate of 1.1 to 2.1% on average. With consumption growing at that rate, in other words, the only way to grow GDP more quickly would be for China to postpone the rebalancing process and maintain higher investment growth rates for longer. But if you assume that the problem with most of China's extraordinarily high investment is that it has become increasingly non-productive, which by now most economists acknowledge, this can only happen with increasingly risky and increasingly disruptive expansion in the country's debt burden. Put another way, if China wants to rebalance its economy to make it more sustainable and less dependent on surging debt, and if it wants GDP growth greater than 1.1 to 2.1%, it has to engineer much faster growth in consumption. This is just arithmetic. End quote. The third point he adds to the Rhodium analysis is that if China does indeed maintain 3 to 4% consumption growth over the next 5 to 10 years, China's GDP growth may drop sharply, but Chinese residents won't feel the effects, he says, or even notice the decline. Like the Japanese after 1990, he argues, Chinese residents will see living standards rise only a little more slowly than before. The point is that while this kind of slow adjustment may be worse for GDP over the long run, it is unlikely to be socially or politically disruptive. Now, we also note that the Rhodium Group projections are relatively optimistic in their forecast. Consumption growth has been a policy goal in Beijing for well over a decade, and it's proved very elusive to policymakers. Indeed, there are some policymakers who refuse to accept that it's even important. Now, let's return to the Rhodium report and end today's video with some excerpts from its concluding statements, which again have been edited for brevity. We're now quoting selected excerpts directly. Synthesizing all the analysis into the forecast or range of expectations for household consumption growth in China over the next 5 to 10 years is far from straightforward. The key considerations in compiling a long-term forecast, in our view, include the most probable trajectory is that the ongoing and gradual slowdown in household consumption growth continues, rather than suddenly changing direction toward faster growth. As China continues to urbanize, rates of urban consumption growth are far more important for the outlook than rural consumption growth, with the important caveat that less than half of China's population formally holds an urban registration. China's declining population is likely to weaken overall consumption growth relative to the last decade, even if savings rates decline. China has already reached a reasonably high level of per capita GDP, which means that future rates of consumption growth are more likely to converge with global average rates rather than significantly exceed them. Still, given the current low level of consumption within China's economy, it is reasonable to expect consumption growth will trend toward the higher end of the range among developed economies. The impact of the property sector's price decline will have a small but meaningful negative impact on consumption growth over the next 5 years. Dramatic changes in policy to restructure China's fiscal system to promote household consumption through transferring fiscal resources do not appear imminent and cannot be assumed when forecasting consumption growth for the next decade. As the financial system continues its multi-year adjustment, credit-intensive investment will continue to decline. Household consumption is likely to outpace investment growth as credit expansion slows. But overall GDP growth will be below potential growth as capital formation falls below potential. A wide but reasonable range of estimates for long-term potential growth in China is 2.5 to 4%. Household consumption will represent a larger share of GDP in the next 5 to 10 years, but overall GDP growth will slow. Tying all these strands together, the most probable range of China's real household consumption growth over the next 5 to 10 years is around 3 to 4%. That means that consumption will contribute only around 1.2 to 1.6 percentage points to GDP growth per year for most of the next decade, a much lower contribution to growth than in the 2010s. Important uncertainties in our outlook include the prospect that household income is underreported within official data. However, by far the most significant uncertainty that might impact this outlook is the extent of reform to the fiscal system. China's leadership has no magic bullets to rebalance the economy. Beijing must transfer resources away from the government and the wealthy and towards lower-income households. Consumption growth will remain tethered to household income growth and will remain constrained by income inequality. Altering the trajectory of household income growth and its distribution are therefore essential to change consumption patterns. Beijing holds its economic fate in its own hands, but must relax its grip on politically motivated growth targets and the investment-led structures they have inspired. Regardless of how Beijing chooses to report the results of its efforts, we will be watching import levels, aggregate pricing trends, and normal growth to reveal the progress and the trade-offs in finally rebalancing China's economy toward household consumption. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a great Monday, have a productive week, and I will see you all tomorrow.